A very good evening and welcome to the live Shastrartha on the newly introduced co-lending directions 2025. Co-lending, as we all know, has been a very popular product between banks and NBFCs. RBI regulations that were introduced in 2018, the co-origination model, which was very popularly introduced to give some kind of a push to PSL targets that the banks had to hit. So that was the motive behind introducing co-origination guidelines in 2018. Thereafter, in 2020, there was a change and the shift from co-origination to co-lending model. And two types of co-lending models were introduced, commonly known as CLM1 and CLM, which is non-discretionary and discretionary model. Now we have the co-lending framework. Here, the approach is to broaden the scope and also to provide regulatory permissibility to the prevalent co-lending transactions that were there in the market. It is not just restricted to bank and NBFC lending for PSL, but non-PSL loans as well as NBFC and NBFC co-lending. That is very common. So the 2025 co-lending directions that is there, we are here to discuss that and get some insight from Vinod sir on this. The first question that will be here, I think, for us to ask, let us understand what is the impact of the directions on banks and NBFCs? Is it like throwing cold water on their business ambitions, on their kind of co-lending structures that they were proposing to do? How will the banks and NBFCs react to this particular co-lending directions?
Well, that's a very important question to start with. And I was just say that the day the new directions came, we met one of the banks in the country. And the bank was saying that we had set ambitious targets for co-lending. We were looking at adding some 20,000 crores worth of loan book via co-lending model. When I asked what was it, mainly it was CLM2. So CLM2 was the way of growing banking book for both banks. It was the existential model for several NBFCs. Many of the NBFCs were actually thriving on the co-lending model. Many of them actually originated under the co-lending model. And a lot of people actually felt that 2020 guidelines were a game changer for financial interconnectivity in the country, as this led to a completely new way by which banks could latch on to the strengths of NBFCs and reach out to corporates. So essentially, banks were in a situation where corporate lending wasn't happening or wasn't happening strong enough. Co-lending was the way to do, I think, particularly in spheres like gold lending, affordable housing finance, personal lending, digital lending, to an extent, vehicle lending, MSME lending, for example. So several of these so-called retail lending pieces where banks did not have a strength, they were doing the co-lending way, and they were mostly doing it CLM2. Now, whether they were guidelines which were restricted or restrictively referring to PSL only, or whether there was absolutely no mention of the RBI by the RBI on non-PSL co-lending, the market was taking its own course of action. This was happening rapidly all over. So, Anita, therefore, the point is that yes, it does cause a significant change as the ease and the comfort with which people will look at CLM2 as a so-called on-tap direct assignment, and that too with the added advantage of maybe giving a credit support as well. That's something which is not there in CLM1. Of course, the new framework comes with an added possibility of giving a 5% DH. That's something new. So, to my mind, yes, there is a new framework, there's a new regulatory discipline. The discipline is like fit all approach. It captures both PSL lending as well as non-PSL lending. As you mentioned, it looks at all kinds of lending relationship between banks and NBFCs, and so on. Therefore, this is a new paradigm altogether. There is always, effort in learning a new method. There's always some, I would say, friction when you get into a new learning a new exercise. But is this completely something which is going to stop co-lending? I don't think. Actually, I don't think that this will stop co-lending. Basically, the way I see that people will have to now choose. If we are on board from the very first day co-lending, is the model. If I want to come and pick loans or cherry pick loans subsequently, then TLD is the model. If I want a credit enhanced piece, then I will probably go for securitization. So people can make an intelligible choice between co-lending, TLD, and securitization. Earlier, co-lending was seemingly erased. That's something which is sounding tough now. But yes, I'm not saying co-lending would get extinct. It is relearning, remodeling of the co-lending model. So it's something which is going to stay though. There is, of course, a course correction that one can expect. For non-banking finance companies which were aggressively moving on the co-lending model, there might be an initial period of, let's say, relearning or new learning, and therefore there might be initial slowdown. But I'm guessing over a period of time, they will once again come back to speed on the device field of everyone.
Given the positive look that you have provided to the directions, now I think it will be important for us to understand the key changes that the directions have brought. We do understand that the coverage has been expanded and widened to include all sorts of co-lending models. Now, in terms of the key changes or the key highlights that are there in the directions, before implementing the directions, maybe we also want to understand the applicability or the effective date. The regulations have mentioned the effective date to be 1st of January 2026, or in case the REs are intending to do an early adoption, that is also an option available with them.
Right.
Now, what will happen to the existing co-lending arrangements that are already there in place? The disbursements that are going to happen under those co-lending arrangements, maybe before the effective date or even after the effective date. Now that we know that there is a direction that is already in place, if we enter into new co-lending arrangements, can we do that under existing regulations that are already there? And what happens to the disbursements that will be done under the co-lending arrangement?
Okay, that's a significant question. So what there's a grandfathering clause will say that existing arrangements may continue under extent directions. New arrangements entered into or after 1st January 2026 will be under new directions. Of course, it's possible for you to do an early adoption. We might also have to discuss, will there be motivation for people to have early adoption? We can probably discuss that as well. But let's first discuss the first part of the question. What is the meaning of saying that new arrangements entered into or after 1st January 2026 will be under new directions? First, existing arrangements to the extent of undisbursed amounts can be continued to disburse till the effective date? Answer, of course, is yes. Can we continue to disburse after the effective date? My answer would still be yes, because it's an arrangement. An arrangement already entered into will normally talk about a particular amount. We'll probably say, okay, this arrangement will remain effective for, let's say, next 1 year. Or it might say, okay, we'll probably disburse a total of 1,000 crores worth of loans in the arrangement. If the arrangement talks in terms of time, or it talks in terms of a volume, we can continue to complete the time and or the volume. If the arrangements say that it will continue till modified or till we agree to wind it up, then to my mind from 1st January we'll probably have to think of giving it a sunset. So existing arrangements to the extent we have contractual commitment to lend, commitment to hold it, they still continue even after the effective date. First point. Second point, can we enter, now that we know the 1st January is the applicable date, can we enter into arrangements now and do it under the existing extent, existing or extent directions or guidelines actually? The answer would still be yes. However, the question would be, will it be desirable? Now that we know that from 1st January the paradigm is changing, at a corporate governance angle, how do we justify that we're trying to find or we're trying to see a sort of undue haste in executing new arrangements prior to 1st January so as to be, into the existing regime? So that's something which might be questionable though. Legally possible though, but I would still say questionable. So I would advise people to exploit the period from now till 31st of December to enter into arrangements. Therefore, that's my view that yes, it's possible to complete your commitments to an extent. If you want to enter into arrangements now, you can probably still enter. But should you be entering, that's a different issue. On the question whether there will be a motivation for early adoption, I still see a strong reason for people to try and do early adoption as well. For at least 2 reasons. First reason is that this framework explicitly allows you to give DLGs.
CFGs.
DLG is something which wasn't explicitly permitted for co-lending. In fact, people were doing that, but I don't know whether there was adequate legal basis for doing that. Now there is a 5% DLG clearly permitted. So number one, you have a clear basis for giving DLG. Number two, DLG in the past was possible for digital lending only. It wasn't possible for digital lending. And this co-lending framework permits you to give DLG for non-digital lending too. So to be able to provide DLG to the extent of 5% for digital as well as non-digital loans, and also to be able to bring down the share from 20 to 10, because 20% was explicitly stipulated in the 2020 directions. People said there's nothing for non-PSL, so people were drawing their own inferences, but that's actually may not have been correct. So now we know that 10% is the minimum funding share required. You can actually bring it down and as well. So I would say there's the region to early adopt. So A, we're able to bring down the share to 20 to 10, and B, that in addition to this is the addition. In addition to the 10% funding share, I can provide a 5% DLG too. Note that the 10% funding share is funded. The 5% DLG is also funded. So both are funded. In a sense, you have a funded share which is in form of credit protection. You have a funded share which is in form of tariff sort of, let's say, equal participation. So that's a combination of funding with credit support and funding without credit support to the extent of totally 15%. That's the merit or the beauty of the new direction. So we'll probably find a good region to do early adoptions.
Also, I think because the permissibility that was not present in case of non-PSL or NBFC to NBFC co-lending, which now has been specifically recognized. So I think people, NBFC should now switch to this particular model, and all the arrangements that they're doing, they should maybe opt for it earlier.
But I would say you might need to have a systemic system or technology-driven ability also, because operationally this model is different from the past. Because we'll probably discuss that the provisioning in the past asset classification of that we align disbursements have to happen a particular way, etc., etc. This might require technological preparedness, but if you're able to bring that preparedness in good time, and of course you might be depending on technology platforms even all the more strongly now. If you're able to bring that on table, then there might be a strong reason to do early adoption.
So also we were discussing about two prevalent models that are there in place right now, which is CLM1 non-discretionary and CLM2 discretionary co-lending model. Are we saying bye-bye to CLM2? Are we saying that no longer it is a cherry picking of loans that can be done by one of the co-lenders?
So I would say, okay, I love it. I love CLM2, but then, well, unfortunately, it's in our way, it's quite clear that CLM2 is no more there. So you can write a nice, decent eulogy. You can write, emotion choked obituary for that. But well, this seems to be the fate accompli now. CLM2 is gone. Why are we saying it's gone? Because explicitly the new directions talk about an irrevocable ex-ante commitment to pick up a particular shape. As to how the mechanics will work, we will discuss it further. Will it be like loan by loan, credit DD by each of the co-lenders to begin with? But what it actually means is that you cannot come and pick. You cannot come and cherry pick loans after they will disperse. There is a time frame of 15 days to execute the transfer and the funding transfer. But otherwise, from the very first day, it's clear that loans originated under the CLA, the arrangement, will have to be picked up by the respective parties. Irrevocable. There's no question of, therefore, choosing to pick or cherry picking approach that's not permitted, which means CLM2 is for all practical purposes, no more. I mean, after 1st January for new arrangements will no more possible.
But you mentioned a time period of 15 days, which is there to transfer the share to the other co-lender. So can I now utilize that 15 days time period to actually select the loans or cherry pick the loans?
So first question, Anita, is that let's understand first what's the rationale of the 15 days and whether the 15 days can be used for so-called cherry picking. But that's the second and more important part. First, let's understand why the 15-day time frame. Original draft of the new direction said that from the very first day, the money should be in the head of the originating co-lender. That's the funding co-lender. The bank should put in money with NBFC from the very first.
Yeah.
Now that's not there anymore. It's saying the fund should be transferred. That would be the originating NBFC may disperse the entire funds immediately on the very first day, and then shift the whatever agreed share, let's say 90% share to the bank within 15 days. So within 15 days, you shaft the loan, and corresponding the bank puts the 90% share to the NBFC. The outer time limit for that is 15 days. 15 days is the time for completing this exercise of, jotting down what all loans have been originated, because mostly the origination, then the transfer won't be happening on batch basis. Deciding the batch, finding out which loans fitting into the batch, shifting the loans to the extent of 90% to the bank, and getting the money from the bank. For that, the time it is like 15 days. And the regulation also goes to say that if fail to do it in 15 days, then the entire loan will sit with it. You can't then find a new co-lender for that. The entire loan will then sit with the NBFC itself, which means 15 days is not the time for cherry pick. 15 days is the time for completing the process of funds transfer. Now, can the 15 days actually be used for cherry picking? I would say, how do you cherry pick loans? Can you smell a loan cherry pick it? Like you pick cherries, you can probably smell them, kind of hold them in your hand and probably see, oh, sounding nice. It's good color, looks like juicy, it's tight enough. So that's the thing. Can you pick up cherries the way you pick? Can you pick up loans like pick mangoes, for example? Is it like mango picking? I would say a loan, the only way to pick up a loan is based on the loan behavior, based on loan performance. So 15 days is not even the time for the first EMI to come. So how do you test the performance of a loan to be able to do the so-called selection if the time frame is 15 days? That would mean 15 days is not at all, a time from, any meaningful selection. The selection, whether you do it on first day or 15 days, is all the same, because ultimately you are settled with the same. So in my view, the 15 days is not helping in terms of selection. It's a strange case. Whatever loans are originated in terms of the policy, in terms of agreed parameters, because lending is mostly parameter based. Mostly the lending that we're talking about is for retail loans. It's not like a 10 crore corporate loan which is lent by CLA. CLA is mostly for retail lending, where the lending is based on parameters or algos which are predefined. As long as the loan is fitting the parameters, other lender takes it as simple.
So in terms of the funding, how do we understand the funding mechanism? Because there is an escrow requirement. Are both the co-lenders refunding the loan, or is one co-lender allowed to disburse the entire 100% and thereafter take the money from the partner?
Yeah, the funds movement has to be through an escrow so that there's no co-mingling of funds. That would be the bank was to move the 90% share to the NBFC regular banking account. That would almost mean the money is like, free for use by the NBFC. Therefore, any movement of funds by the funding RE to the originator, from the originator to the borrower, repayments from the borrower to the respective co-lenders should all be routed through a particular escrow, so that we are not intermingling or competing the funds. However, it's clear that the funds don't have to be placed from the very first day. That was there in the draft. It's not there in the final version. That would mean the funds don't have to be present with the NBFC in the first day. Like I mentioned, you have an Indian time frame for shifting the 90% share and getting paid by the funding.
In practice, if we look at non-discretionary, would mean that the credit DD of the loans that we are about to originate must be done by both the co-lenders before the loan is being sanctioned. So you also mentioned about an ex ante agreement or ex ante. In wholesale lending, or when there are corporate loans, there is still time period, and both the co-lenders will still think and take a decision or evaluate the profile of the loan. But in case of retail lending, it is mostly automated. Digital lending, as we have already been discussing, it is based on an algorithm, or there are pre-decided parameters based on which the lending is done. How will this non-discretionary model work in case of co-lending?
So to my mind, it's as simple. The process by which the loans were originated by the originating RE, if the loans were to be on its own books, versus the same process if the loans were to be in the co-lending book, will exactly have to be the same. For example, if my lending was parameter based, it remain parameter based. My lending was, let's say, elbow based, remain elbow based. My lending was based on, let's say, at least some level of interaction with the borrower and still do it. Essence is that the borrower interface will still remain with the originating end. That's the whole purpose. That the NBFC charges more because it does a lot of services, including borrower interface, loan sourcing, etc., etc. So the sourcing bit will still be with the originating NBFC. the funding NBFCs with the originating NBFC in terms of laying the credit underwriting process. The credit underwriting process is jointly laid based on the more rigorous of the two kind of, I mean, call it the more stricter of the two kind of regime. And therefore, the loan has to be fitted into that stricter of the two regime. Once it fits, that's how it's dispersed. So they disperse, and I'm sure you also pointed out that the name of the co-lender would be there in the KFS itself. How do you write the name of co-lender unless I know who the co-lender is? There's a decisiveness on the very first day of disbursement as to who the co-lender or co-lenders are.
Then does that mean that there is no scope for the funding co-lender to reject the loans? There is no scope. Is this a commitment from the funding co-lender that I have to stick by this loan and I will be a co-lender in this loan?
I would put it this way, while there is an ex ante irrevocable commitment to buy, but commitment to buy subject to reps and warranties, subject to conditions, subject to reps and warranties. If as a funding co-lender, I'm able to find a deliberate deviation. It's a case of deviation. Deviation from filter, deviation from process, or breach of reps and warranties. Would I not have the right to say that this is not something which is meeting our pre-agreed condition? Therefore, you need to, I mean, I will not therefore pick up my share because it's not something that I would have agreed to. This is, however, more like an event of default. And I wouldn't take it as a way of business. I wouldn't take it as business as usual. This is more like an exception. And if these exceptions occur recurrently, then to my mind, this might even be a strong reason for the funding RE to terminate the arrangement because this is like a, like I mentioned, it's a deviation. It's like an event of, it's like a default. So except in case of a deviation or event of default, I would say yes, the agreement remains in force. The agreement to pick up that share remains in force.
This also, the regulations also talks about recognizing unrealized profit on transfer if applicable. Now, we are discussing that this is a non-discretionary model. There is actually no transfer of loans that are happening. And from day one itself, both the lenders have agreed to lend to the borrower. Why is this concept of gain on sale of loans coming over here? And is there at all a possibility to recognize such a deal in case of the non-discretionary co-lending models?
So, Anita, gain on sale is a concept which is a gain, like the word itself indicates, gain on sale. There has to be sale. In order for the gain or loss to be there, it has to be sale. Sale meaning what? I had something that was mine, and then I decided to sell it. When I do a sale, in case of co-lending, as you mentioned, from the very first stage was understandably a joint origination. By co-lending is actually a co-origination. It was co-origination. Both parties had pre-agreed that these loans will be to the extent of 90% will be shared. So the loan was anyway to the extent of 90% already or always the share of the funding RE. Therefore, it's not a case of me exercising my discretion to sell a loan and put in control of the buyer. The control was there from the very first stage. It's not a case of transfer of control, it was a case of conservation of something which already was supposed to be bought by the co-lender. Therefore, I wouldn't take it as a case of gain on, I wouldn't take it as a case of transfer at all. I wouldn't take it as a case of derecognition or transfer. Therefore, I wouldn't suggest anything for gain on sale on such transfers. Though, looking at the RBI's inconclusive language, I know for sure people will try to, I mean, get some arbitrage out of it, but that's, to my mind, that's not either in terms of Lodi principle, not possible. In terms of governance, I would not suggest.
Okay. Now this was very common that both the co-lenders are coming and they have a very way in the lending arrangement. One of them is sourcing, doing the customer interface, and the other maybe the larger funding part. It was also very common that a servicing fee was being paid by one of the co-lenders to another. Now, under the new or the revised framework that we have, can the co-lending partner, one of the co-lending partner, which is funding, pay a servicing fee to the originating partner? Are there any restrictions or any concerns on that?
Yes, so that seems to be possible. Because there's an explicit reference to payment of fees and charges. And I mean, Regulation 20 goes also to say that payment of fees and charges will not be used as a mode of credit finance, which would mean what? Deferral or abatement of fees and charges so as to increase the level of support beyond the 5% DLG. The regulations say that other than DLG, you cannot provide any further support. Therefore, don't use the payment of fees and charges as a mode of enhancing or increasing the levels. So, from language of Regulation 20, it's possible, it seems clearly possible that the funding RE may pay fees or charges to the originating RE. Question is, what sort of fees? I would say mostly it will be in form of servicing charges. Now, here comes a very interesting question that given the fact that now the regulation explicitly permits payment of service charges by the funding RE to the originating RE, are we not opening the doors for a GST officer to come and say that the differential rate of interest is actually nothing but a service charge and therefore should be charged with GST? Anita, you are aware that there were already approaches of kind of challenges by GST people that the differential rate of interest is nothing but service charge.
Right.
Earlier, one could argue that how can they be one partner serving the other partner because they are partners in business, they have differential role to play, and therefore the question of service charge does not arise. But if people do use Regulation 20 to structure service charges, as some bankers have told, they pay the differential rate by way of service charges. To my mind, that's not desirable, that's not recommendable. So while it seems possible by Regulation 20, but I would suggest the structure should still talk about splitting the profits differentially rather than the extra out of the interest spread being paid by the funding RE in form of service charge. Because that brings in GST and that also puts to question the entire differential interest being in the nature of service charge. So I think it throws a very large question to quality practice itself.
I think in case of differential interest, you also have to ensure that while there is a blended rate of interest that is being charged to the borrower, however, each of the lender must ensure that the ROI that they are charging for the respective loan share is in accordance with their own credit policy as well. So I cannot be having a credit policy of 20% for my other loans, and for a co-lending loan, I will be charging 30% on my 10% share. So that would be not in line with my own interest rate policy as well.
I think that's a very valid point that you're making. Therefore, if in my regular loans to similar segment, my rate of interest is 20, for example, in co-lending, given whatever the other bank is putting, for example, at 12, and my rate of interest to borrower is still the same. Therefore, I end up making 32 because I've got a 9 is to what leverage there. It's like leverage 9 times. So my ROI becomes extremely high. Will I not be questioned as to what was the basis of fixing my ROI? Because somewhere that should also say that interest rate charged by each of the lenders will be fixed by the respective interest rate policies. So if my eventual leverage rate of return works out to be significantly higher than the standalone rate of interest, then the difference may once again be challenged as the nature of service charges. And if a service charge, then implication of GST as well as deduction of tax and so on also come. So it's a complicated question also.
Last question that I will have is that I am already co-lending. If I want to exit from this, do I have a possibility of transferring my share? Do I need any sort of, there are any restrictions or any approvals that are needed from the other group?
Right. So first, as far as the directions are concerned, the directions are put it on explicit concept. That you can do it with explicit concept. Now, question is, who is transferring to who? We're talking about a 10%, 90% partnership. That 10% partner is the sort of, the master of the ceremony. That's the end. The entire business is being carried by the 10% partner. The originating partner is not merely originating, it's originating and servicing. The entire portfolio, the entire business is handled by the originating RE. So, should the funding RE allow the originating RE to exit? I think logically, I would say the funding RE should not permit that because the entire business is piggybacking on the strength of the originating RE. And if I'm piggybacking on somebody's back, and I would say the back itself will shift down, and then I will flat on the ground. So I would suggest the funding RE should actually restrict not merely a transfer, but transfer encumbrance or securitization by the originating RE of his. Now there are two other possibilities. The funding RE wants to transfer his share. Now his business merely the financial. His share is largely financial. So should the funding RE be able to sell his share? I would say very likely yes. And you will probably have a prior concept of that in the co-lending agreement as well. It provides that the consent of the originating co-lender to such transfer by the funding RE is hereby, that would be by the agreement itself, hereby granted. So you don't need to once again run to get consent. The third possible scenario for transfer of shares is the originating RE transferring his share to the funding RE or vice versa, the funding RE transferring his share to originating RE. The both have their own implications. Originating RE transferring his share to the funding RE is basically meaning what? The originating RE was selling it at the share and now completely exits. Therefore, the entire loan now sits with the funding possible. Look at vice versa, the funding RE transferring is 90% to the originating RE. That is where the question of this being used as some sort of implicit support might come in, because normally that transfer would happen only when the loans have started showing some delinquencies or have already built up some baggage of delinquency. At that stage, the funding RE shifting the dirty blanket already to the originating RE, but seem like trying to wash the sins of the wash the dirt of the loan. So I think that would probably be questioning.
Now that we are doing a live Shastra, this is the opportunity for viewers also. In case they have any questions, we have the privilege to Mr. Spudhati over here. So if there are participants on the Zoom, if they have any questions, you may please put it on the chat box, or in case you would want to maybe unmute yourself and speak.
Or if there are questions already, our colleagues should probably speak if there are any questions at all. Sorry, we'll wait for a minute before we.
Hi, this is Pallavi.
Yes, ma'am.
Hello. Yeah, hi. So I have a question around DLG. Now, since digital lending guidelines allow LSP to provide 5% of DLG, and now in co-lending, only originating RE can provide 5% of DLG. So, can a funding partner, originating partner, and LSP can enter into a tripartite agreement for this?
Okay.
Yeah,
Then
yes, sir.
agree that it will. So let me put it this way. There might even be always you can do yourself just to yeah. So there might be two situations. Number one, there is uh, okay. So then the entire arrangement may be supported by the DLG of a third party, which might be LSP. Third party LSP providing a DLG for the arrangement itself. The benefit of that goes to both the co-lenders. Therefore, that's a third party DLG which is being given by a loan sourcing partner. Are we saying that now the co-lender may provide, the originating co-lender may provide a 5% DLG on top of the third party's LSP, I mean third party's DLG? Our answer would be no, because 5% is the total limit to DLG. The DLG provided by the originating RE also has to be as per the DLG frame. The DLG framework provides for a total of 5% support, not 5% by each of the guarantors. First question, can it be from third party as well as the originating RE? I would say even if it is, the sum total will still be 5%. So that's part one. Part two, if the originating RE provides a DLG, there might be question on how will this DLG work? Because typically the guarantor is not a co-lender himself. Guarantor is a sellist.
Yes.
Here we're talking about an originator providing a guarantee. Is he providing 5% guarantee to the share of the funding RE, or is providing 5% guarantee on the loan pool? Our answer is the guarantees for the loan. The loan cash flows will be supplemented by the payments to come to that. That will be whatever the collection from the loan, on top of that supplemented by the drawdown from the guarantee, that becomes the distributable cash flow. And that distributable cash flow will be split in the agreed ratio of 90-10 or whatever between the co-lenders. It's not like the originating co-lender is providing a guarantee to the funding, it's providing guarantee for the loans, not for the cash flows of the funding. So that's it's an important point to understand. So, I mean, a lot of people actually at first instance say, oh, I'm providing a guarantee to the funding. No, I'm providing a guarantee to the funding RE and providing guarantee for the loans. Benefit of which actually will go to both the holders. Balviji, I hope you answered the question. Yes, you can take a third party guarantee, but the third party guarantee will not be in addition to the originating RE's guarantee. The sum total
Understood, sir.
is
Understood, sir. Thank you so much.
This is Sudha. I have a question. This is on para 24 of the regulation, which says that if the originating RE is unable to transfer within 15 days, then they have to follow the DA regulation. So does it mean that the transfer within 15 days can be 100% without compliance with the DA? So can they offload the 10% or 90% fully?
So because under the co-lending regulations, there is a requirement that you need to ensure minimum skin in the game of 10%. So you cannot be transferring 100% by virtue of para 24 because para 24 is coming from the co-lending regulations.
okay,
You
let's put it
put
this way, Neha. But let's say the 15-day time is gone and I've not been able to place my 90% share on the this one. I have not been able to place it on the funding arm. So the loan is now entirely on my book.
Right.
So after the minimum holding period, can I shift the entire loan to someone else? Of course, yes. Because all the difference, there are two major differences between the co-lending framework and the TLA framework are that A, there is a minimum holding period which is not in co-lending. B, that in TLE there is no question of a credit enhancement, whereas in D, in co-lending, you can give up to 5% PF. So you will not be able to give a DLG at all, and you will have to adhere to the minimum period. Subject to that, TLE permits 100% of the loans to be transferred to any person, including that funding RE in case it's still willing to buy the loans.
But that is after the expiry of the 15
And
days period and the
MH.
MH.
I wouldn't say 15 days plus MH, I would say MH.
MH.
Sorry, I'm sorry to interrupt. So does it mean it cannot happen at all? So you cannot transfer 100% within 15 days?
Not within 15.
Within 15 days, minimum 10% funding share is still required. 15 days over, that would mean the loan is now, I'm settled with the entire loan. The loan is now on my books completely. That would mean now for me to be able to transfer this loan to any person, including that funding RE, I will have a minimum holding period of 3 or 6 months, as the case may be, after which I can transfer to anyone. I mean, anyone who's any regulated entity, of course, without any concern. There, I don't need an 10% pledge.
I think the question was within the 15 days, that cannot be.
Within this, it has to be with 10% funding share is a precondition. That's a very definitional feature of co-lending. Definitional feature of co-lending is sharing of the loan itself. Sharing would be minimum 10% share has to be there with the co-lending.
Hello. Hi, sir. Ajinkya here. So I have a question related to the 15 days timeline that provided to the investor to invest in the particular loan. Suppose we have made the disbursement to the borrower and within 15 days investor wish to fund that loan. Now my question is that do we need to sign any legal document with the investor related to this particular set of loans where investor wish to enter or fund these loans? Like in a DA, we do the assignment agreement. So do we need each and every time to sign this kind of assignment agreement with the funding partner?
Okay. Mr. Ajinkya, first of all, the agreement to buy the loan or the loan share is not within 15. That's before disbursed. That's a that's what the regulation says. Ex ante, prior agreement. The agreement or the arrangement is in place even before you went to disburse for a certain set of loans. For example, we decide that we go for co-lending, let's say for gold loans, and let's say to the extent of whatever 500 crores. The arrangement is in place even before we originate because it's capped. The loans to be originated are captured by the co-lending arrangement already because you'll be making a disclosure to the borrower that I'm going to co-lend the year along with me too. That's part one. there is no question of entering into an arrangement after dispersal. The arrangement is there before it. But your more important part of the question is, when I transfer 90% share, do you have to enter into a deed of assignment? See, we have been told that people, I think lawyers are probably asking for such assignment agreement. In our view, it's not assignment law. It's not a case of assignment. It's a case of co-origination. It was jointly originated. From the very inception, the 90% share was to belong to the funding RD. I am simply conjugating the transfer. I am not agreeing to transfer something which was mine. I'm only executing what was pre-agreed. It will be split in the ratio of 90-10. So in our view, no assignment deed is at all required. The co-lending arrangement, which is the what you call integrated agreement, is already in place. The loan agreement with the borrower say that I will co-lender, that's it.
I think this 15 days period that has been provided
For
is
funding.
more relevant also if there are more than one funding partner. So I may have an arrangement with more than one funding partners, and at the time of issuing the KFS, I usually may be disclosing the names of, say, the 3 funding partner that I have.
Uh-huh.
Now this 15 days period allows the funding partner also or me also to decide that which, because if it is the borrower is fitting into the credit criteria of all the 3 funding partners. So the 15-day period is actually to decide on whose books it is actually going to.
Anita, this I have doubt if it's any more possible. This is something that people were doing earlier because the so-called CLM2 was helping them do that. But now under the new regime, I don't know whether it would be possible for the KFS to say that I might either have X or Y or Z as the co-lender. I'm probably to say I'll have X. Because having that open-ended co-lender to my mind will, this is something that I would once again say, it's just a bit of reading. To my mind, that's not possible, A. And B, therefore, the 15-day time is not for deciding who to, shift it to. The 15-day time frame is merely for complete. I know that it's need to go to the refund. I'm just taking 15 days to fix up the batch because the transfer obviously happens on a batch basis. Not like every loan I will keep transferring, it happens on batch basis. So for a batch process to happen and for the funding transfer therefore to happen from the funding RE based on the batch, that's the logistics time limit of 15. Let's not therefore use 15 days to see if this is key decisions as to who is buying, whether to buy. No, that's not for decision making. It's all pre-decided. We're taking 15 days simply to complete the logistics.
Okay,
Hello,
sir.
sir.
Thank you.
Hello, sir. Good evening. This is Bharat. Sir, just one question on related to the 15 days time period only, more specific related to para 34, wherein it mentions that if by any chance we are not able to do the transfer within 15 days of the proportionate share, we can do the transfer basis the TLE provisions, but with the mutual consent of both the parties, like even the partner RE. Now, I just have a doubt whether this consent, whether is it something that we can call it out upfront in the master service agreement, or it should be a case-based consent at that point of time that we need to take.
So, Bharat sir, in my view, that's what I mentioned that in the co-lending agreement, the concept of the originating RE to permit the funding RE to shift this share, to sell this share, may be pre-embedded. You might say that this agreement does hereby communicate that the originating RE permits the funding RE to sell the share. Or it is basically the intimation, not a consent as such. To my mind, it can be pre-embedded. Para 34 is different from the para 24 that we're talking about. Para 24 was talking about if you are unable to complete, the transfer of the share within 15 days. Para 34 is saying the loan is now disbursed already. We have 98 share. Either of the two parties want to sell their share.
Either for third party or to each other.
Or to each other. So that's where para 24 comes. That has to be, of course, in compliance with TLE. But yes, Mr. Bharat, I would say, to my mind, the consent of the originating RE may be pre-embedded. If somebody asks me, can the consent of the funding RE be also pre-given? I think that would be bad. That's not a good structure. Because the originating RE is the fulcrum of the entire transaction. The entire transaction is resting on the origination cum servicing abilities of the funding of the originating partner. So permitting him to shift out is like the horse shifts and the rider falls on ground. That's how it is.
Sure, sir. Thanks.
So I think
Any other question, anyone? Or
Am I audible?
yes,
yes.
Hi, my name is Yogesh Gath. I've already sent a question on the chat box. Would you just see that? It's a long question. I'm sorry.
okay. If you can maybe help us to understand the long question briefly, Mr. Yogesh. If you can maybe help us to
Sure,
understand.
I will do that. I'll read it. So, sir, my question is DLG of 5% is at a loan amount level. That's my understanding. Now, as the loan runs down, the pause keeps.
Correct. Right.
So should that, it should be 5% at any point of time during the tenure of the loan, or should it be stamped at a loan amount level is my.
But
Let me just rephrase the question
that
for the benefit of the audience also. The provisions of DLG, they specify that originating RE will provide default loss guarantee up to 5% of loans outstanding in respect of the loans under the CA. So now this 5% is of the outstanding loans because the DLG regulation that is there already in place, that talks about 5% of the loans originally disbursed. Right.
So I think it's a I mean this wrong language. I would say the government says it has to be as per the DLG directions. In our FAQs which we uploaded yesterday, and kindly refer to our FAQs as well, we have given an elaborate answer to this question that this actually cannot be based on the loan amount. Guarantee can never be based on loan amount outstanding. Guarantee is always based on loans originally disbursed. For example, if I've disbursed 100 crores worth of loans under a particular cohort, the 5% guarantee will be on 100 crores. The 100 crores continues to run down over time. But the 5% guarantee is to the extent the loans do not run down. The whole purpose of the guarantee is for helping those loans which do not pay. Therefore, I cannot break down the guarantees the loans actually pay. But that would actually be counterintuitive. So while the regulation talks about loan outstanding, it's actually it's a mistaken. The word loan outstanding is actually incorrect. But I think what helps is that it's anyway referring back to the DLG circular, which is quite clear. It's based on the originally disbursed amount of the loans for which or to which the guarantee attaches. So it's mostly on cohort basis. So whatever is the original principal on the loans forming part of the cohort, 5% of that would be the maximum value of guarantee, which is to be used, till the cohort completely pays off.
So I'm not actually guaranteeing 5% of the outstanding, but I'm guaranteeing the cash flows from the forward, which will have a share of my shares.
I would say I'm guaranteeing 5% principal on the loans already lent, which may be used for making good default on principal or interest of the loans as they run down over time. But it's 5% on the original principal, not on the then outstanding principal.
I think there are a few questions.
Okay, thank you. Sorry, Anit, I had a follow-on question on that only. I'm sorry.
What?
Since you mentioned cohort, do the originating RE and the funding RE have a freedom to decide cohorts? I can define a quarter as a cohort, and then I can give 5%. So 5% for cohort one of quarter one, 5% of cohort for quarter two, and the commingling is not allowed. Is that freedom given to the funding RE and originating?
Yeah, between the cohorts, they cannot be done. Correct.
There cannot be.
Yeah, Yogesh ji, I would agree with you. You can define the cohort yourself. I will say you can define the cohort yourself, but there's always a method in choosing the cohort. The cohort is a very basic of the guarantee. The amplitude or the extent of expanse of the cohort, that's the very essence of a guarantee. A guarantee structured, first clause report guarantee makes sense. The wider the pool, the more is the protection granted to the beneficiary of the guarantee. So the wider the cohort, the better it is. From the point of view of the guarantee taker. From the point of guarantee giver, of course, it's exactly opposite. But idea basically is to provide protection. Therefore, the wider the cohort, the better. Therefore, I can definitely provide a guarantee based on a quarter as a cohort. You are putting that 5% upfront. But the use of that 5% will only be for the loans actually disbursed. That would be why you are giving 5%, say, on the basis of the loans to be disbursed on an estimation basis during the quarter. But the actual use of the 5% will only be for the loans actually disbursed. That would be their actual disbursement is less than what you estimated. You can't therefore increase the salary of the guarantee. I hope I'm clear.
Yeah, thank you. Thank you very much, sir.
Two questions that I think
Uh,
chat box.
Hi, Dishant here.
Okay, this question.
Yeah, so as we are already making the solution of CLM1 and DA from Night Fintech platform, so just want to understand some queries on this current co-lending, the points which you have highlighted earlier. See, so when we are doing a CLM1, and if the selling is happened to the senior lender on the 90%, and then if the senior lender wants to do the transfer of loan to another RE after a minimum holding period of 3 to 6 months. So in that, the entire pool will be sent, or in that there will be sharing. Like any minimum holding will be there for the senior lender, like the RE which have considered the CLM 90%. They have to hold anything on their side, or they have to completely transfer it to the.
You are saying, of course, the transfer would be after the minimum holding period, which you also mentioned yourself. But you are saying, will the selling co-lender, the funding co-lender who's selling his share, will still have to retain a 10% share? That's the question.
Yes.
Yeah.
So that's the answer. Answer is given in the period directions itself that if you've done basis 100% due diligence, then retention is not required by the pending RE. But if you're doing it basis 33 to whatever 100% due diligence, in that case, minimum 10% retention will be required. So there might be a need for a 10% retention at the selling RE level as well.
Okay.
That is something from the daily regulations and not from the co-lending. Because from co-lending, if you have co-lend the loan, at that point of time, I'll see that the share of each of the lenders, minimum 10% is there.
Of course.
But after, once the co-lending has been done, after the MHP has been met, thereafter, if I'm wanting to transfer the share, it can be 100% transfer
Provided the DTS.
in accordance with the TLD.
So if we are shifting from co-lending to TLD direction, that will be different according to TLD direction.
Okay, so one of the confusing question here. So originator has done the co-lending with the senior RE. In that there is a DLG of 5%. Then senior RE is selling it to as a TLE to another senior RE. So will the DLG be applicable then, or then it will not be considered?
It's mostly like I mentioned, the DLG is for the loan. The DLG is not to the lender. The DLG is for the loan. That would mean, should there be any default or shortfall in the loan, the guarantor will fill that gap.
So guarantor will be filling it to the 90% of the senior RE.
That's exactly what I was saying. The guarantor will fill the gap in the cash flows from the loans. Loan
Okay.
is still consisting 100% of the loan. Gap there will be filled up by the guarantor. Once the guarantor has filled up that gap, now the cash flows are split in the ratio of 90 and 10. 90% goes to funding RE. Assuming that funding RE has also sold 90% of his share. So now you've got 21, 9, and 10. So there are three partners now. So the benefit of the guarantee will accrue to each one of them. Because the guarantee is for the loan, the guarantee is not for the lender. The guarantee is for the borrower. And therefore, the benefit of the guarantee goes to each of the lenders or the borrower.
So this is a guarantee for the loan and this is not a credit support for the loan being provided under TLD.
But it's served in credit. It's served.
The loan itself was guaranteed and not
Credit financing is the loan. I'm not credit financing the lender. I'm credit supporting the loan. The loan and the service.
So just last question on this. Sorry, I'm stretching a bit. The last one is where if if the customer is paying after the DLG is adjusted, and if the customer is paying, so do we need to reverse from all the three about the DLG amount, or like how it will work?
So I think once again that is provided for in the DLG directions, whether recoveries from the customer after the guarantor is paid will need to be shared with the guarantor or not. That's based on the mutual contract. Contracts commonly say that the recovery will be shared, but the contract may provide that the recovery will not be shared.
Okay, that is subject to the agreement.
It's based on the guarantee. In general, Mr. Joshi, are you happy with the directions? US like the big stakeholders in business. You are happy?
So we are still processing the entire solution, and that's why we joined. That your inputs will be valuable to understand exactly. So we are already in place to work on the changes that are in place,
Right.
and your inputs are really helping us to understand.
Right.
Thank you.
Yeah.
Yeah. Hello.
Hi, Mr. Vivek.
Yeah. Yeah. Hi, sir. Good evening. So I have a very small questions. So I raised on a chat. So currently we have a co-lending arrangement with 100-0. Like so, as a co-lender is a 0% contribution, and we both are NBFCs basically. And so how will impact basically from the RBI point of view? So let's say that is 10% is mandatory to maintain from the effective from 1st of, January.
So Vivek Kumar ji, in our view, there's nothing called 100-0 co-lending. And co-lending by definition means we are co-lenders. No one
Right.
can be co-lender with nothing in the loan at all. So to my mind, it's a misapplication of the concept. I mean, sorry, I'm using it.
No worries.
It might be
Sure,
strong,
sure.
but in our view, co-lending by definition means there's a share of the loan co-lenders. That's the share has now been broken down from 20 to 10. But does it mean that till the effective date, 100-0 is still kosher? I will say 100-0 was never kosher. So what was never kosher cannot become kosher. Now that there is a, well, I think it's now coming quite clear that 10% is the minimum retention, minimum funding retention by each quarter. So that's a view of it.
And that is in case of co-lending, but 100-0 as a sourcing arrangement as an MSP that can still.
You don't call it co-lending.
Don't call it
loan processing, loan sourcing.
Okay. Thanks. Thanks for the class.
Any other question at all in the chat, which we need to be answered?
What happened if both having interest rate linked to different benchmark
There.
and in future one benchmark change, how will it work?
There's a clear provision of that if both the co-lenders have decided to put the lending rates and link the lending rate with specific what you call benchmark rates, then that should also be explicitly mentioned in the KFS. And then the changes in the respective benchmarks. Let's say, for example, SPA is one, let us say my SPA level will prevail. Let's say other co-lender is, for example, at the extent says my company's lending rate will prevail. So both of them are linking the interest rate with benchmarks. That would mean the interest rates are now floating, not fixed. Then the basis of the variation should be named very clearly in the KFS, and the revision in the blended rate will be based on changes in the respective benchmarks. But to my mind, I think there's separate. Here, Anita, I've done another Shastrartha where we mentioned that people should now think of moving from floating rate lending to fixed rate lending, particularly for short tenure loans. Because you can't charge prepayment penalty for floating rate loans. That's another perspective, but please do hear our other video on prepayment penalties as well.
I think one more question that is there on the chat box, which is the last one. As a statutory auditor of NBFC, what do we have to generally keep in mind on staging, ECL, financial reporting disclosures, and compliances in laws due to this amendment and new regulation?
So question basically is, will the ECL from in case of co-lending, of course, ECL provision has to be done by both co-lenders will create ECL basis their own ECL engines for the respective shared loans. Can it be such that the ECL provision of one partner is different from the other? Ideally, it shouldn't be because after all, it's the same loan. But both might have their own basis for assigning probability of default and expected losses. So it's perfectly okay. Both of them have their different estimates of ECL. But of course, the base data, which is moreover performance, is common, which is coming from the loan pool itself. Now, as an auditor, what implication does it have? I think very important implication is that the asset classification, which is SME or NPA classification, is now linked with, which means the what's the if one has assigned an SME 1 to SMA 2 or NPA status to the loan, other person or force will approve. So that's the bad part of that. We are going by the worst of the two in terms of SMA or NPA classification. ECL can still continue to basis your own respective whatever ECL computation methodologies. I think that's
disclosures. I think is
well
under the notes to account that is provided under the regulation.
And as an auditor, you are normally expected to check adherence to RBI regulatory requirements. This is one of the RBI's direction that was mandatory. And therefore, as an auditor, you should try and see if the actual conduct of co-lending business is in accordance with the direction.
I think that brings us to the end of the Shastrat, and I will thank you to the audience who have joined us. And
I was saying, we had very interesting discussion, particularly on the 15 days time frame. We didn't realize that 15 days will have so much of interest, so much of attention. But it's quite interesting to understand that. We also, keenly observe that people are looking at from different perspectives. The technology providers are seeing from different perspectives. Whole lenders are taking from different perspectives. Fintechs will probably have different perspectives. The whole interesting part that everyone sees what it needs to be, and that's what makes it interesting. So thank you everyone. Thank you for joining, and
I think till the time the regulations are effective, we have further learnings and we may do further webinars on this.
and given the fact that you're now heading for the into the weekend and probably Independence Day thereafter. So happy Independence Day everyone, and please do enjoy it. Thank you very much.
Thank you everyone.